Street. I traded billions of dollars worth of bonds. When I went to work on Wall Street, I was convinced that I was going to learn all there was that I could learn about markets and how to manage money. I met good people on Wall Street, good, smart people. I want to thank Keith and Courtney, who set up my presentation really well. Smart people. Isn't it wonderful to be around brilliant minds? What a gift that is. But the overall philosophy of Wall Street, didn't learn anything there. Didn't learn what I thought I would learn from the experts in terms of how to grow money, how to build wealth. It was not about building wealth. It was about selling you something that you then owned. So you're then left saying, okay, I own this security. When should I get out of it? And you say to yourself, oh my gosh, this market's going to go up. Oh my gosh, this market's going to go up. Because you only have one strategy. You bought low and you expect to sell high. Does that make sense? So what's been happening in this market? Does your buy low and sell high strategy work in this market that's rolling like this? No. So even if you know you're going to get a profit at some point, how far out do you want to go before you go around in the bend in the curve? It can be a long way out. And most people, if you're Warren Buffett, you go, great, wonderful, this market's down, I'll buy some more. If you're managing your retirement dollars from where you sit, that is not your strategy. Your strategy was to have gotten out back here. Keep your dollars, because what is the other thing he says? Don't lose money, don't lose money. So it's a matter of converting to an understanding of what is this market doing. I'll give you another analogy that helps me greatly. I think markets are a little like teenagers. You get a fix on a teenager and you go, good teenager, bad teenager. But you'd never take your eye off that teenager because that good one can go left just as fast. Or the bad one can turn right just as fast. So in watching the markets, if you will just take a look at those three charts on a daily basis, you'll start to get a really good sense of what are you dealing with here? Who is this market? The markets have a historical pattern. They go sideways for 17 years, up for 17 years, sideways for 17 years, up for 17 years, sideways for Did you get that? Shall we do that again? Do it with me. Sideways for 17 years, up for 17 years, sideways for 17 years, up for 17 years. Where are we now? Sideways. We've been for 8.5 years into a sideways market. What does that tell you? Will buy and hold work? No, it's the wrong market for that. The sideways pattern is not expected to change until the year 2010. 2010, you might employ your buy and hold strategies again, but not right now. A buy and hold strategy, well, let's take a vote. Has the buy and hold strategy been the strategy to use this year? Would anyone agree? No. Okay. So does that mean, for most of you, that means you have no strategy at all, correct? Yeah. Yeah. Turn to your partner and say, I have no strategy at all. Now turn to your partner and say, but I'm going to have new tools and skills so that I take charge of my money. So in this market that I've just described, you can be certain that what's going up is coming down. What's going up is coming down. Have you noticed that? What's going up is coming down. Have you noticed that? Up and down. The most important thing to know is the market. You can pick the wrong stock, or let's say you can pick the right stock that is in the wrong sector in the wrong market. So to pick a stock is starting in the wrong place. Money may not be flowing into that industry within the institutional investors. You may have a market that is not a market that's going up. So to pick a stock puts you in the worst position of making money. What would you assume would put you in the best position? Pick your strategy based upon the market. And if you're going to pick a stock, you have to analyze it all the way down. A stock, then the sector, then the market, then the sector, then the stock. However, for my purposes, I'm explaining to you a simple strategy because as I gave you the rule of 72, I don't want you to have a calculator up here or think that I'm the expert. I want that to be in your head. So the next time you're looking at your return, you're saying to yourself, let's see, 2 into 72, that's a long time. Or 10 into 72, yeah, that's going to make my money machine grow the way I want it to grow. So the most important thing to know, first off, is the market. What's the market doing when you put your money into it? This is what investing is not. It's not mutual funds. And by the way, I'm telling you, I'm sharing with you my strategy from my point of view. As someone was saying earlier, I'm sure there are ways that you can argue both sides of any coin, but in the strategy that I'm employing, I'm going to be very emphatic about what I think investing is not. It's not mutual funds. Why? You don't know what's in a mutual fund. It's usually run by a 20-something. They price at the end of the day. The accounting is difficult on them. You have generally no way to track them against the market because you don't know what they're using. I look at mutual funds, and they say, such and such fund, I can't pick anything out of that. I have no clue what's in it or what it's going to do. And although a mutual fund may have a track record based upon a manager's history, those managers can change. So a mutual fund is not a way to track the market in a way that you can know what's going on and you can expect results. It's also, in my view, not a broad spread across asset classes. What I mean by that is it's not, okay, well, I'll have some bonds and I'll have some stocks and I'll have some this. Because rarely, if ever, do the bond market and the stock market go up together. I spent my early years, I'll tell you this story too, as an investment banker, starting the first female investment banking firm. A guy who ran all of Merrill Lynch's bond trading desk came to my office one day, and we scratched our heads and we said, you know, we're not quite sure why people own bonds. Well, the only reason to own a bond is if you're going to treat it pretty much like a stock. In other words, bond prices change just like stock prices change. So when I say not a spread out across asset classes, what I'm saying to you is that if you take your money and you put it in this and this and this and this and this and this in order to minimize your risk, think about this logically as we think differently. If this was going to balance this, what happened at the end of the day would be this, and it would be zero, right? Yeah. It would come out to zero.